Hey guys, welcome back to Upside Down Data. Let's talk about Chainlink. So if you're not familiar with Chainlink, it is mainly an Oracle project that basically provides data to blockchains that otherwise wouldn't be able to get it. For example, a DeFi protocol, a decentralized finance protocol on a blockchain might need to know what is the price of Bitcoin, but have no direct access to that information. Chainlink is able to provide that information to that blockchain, to that protocol, so that they can function. And another big product that Chainlink has rolled out is CCIP, this cross-chain interoperability protocol, which enables cross-chain communications between different blockchains or different protocols. And it can do it arbitrarily, kind of any given private or public blockchain can communicate with any other one using that system. So a lot of people are excited about Link given some of those developments and a lot of partnerships that they've started to form. But then a lot of other people have been really frustrated with Link. They're saying, why isn't it performing better? We had this nice rally early on in October, kind of leading some of the altcoins in the rally, but then we kind of stalled out, had another leg up into the 20s, and now we've also stalled out here again. So what I want to talk about is what our models are seeing with Link and where we stand from that perspective, and then also just talk a little bit more about how to think about an asset like Link and think about its price action. So let's go ahead and start talking about some of our models that we have here on the channel. So this is our upside downside potential indicator. It's a risk model. So basically the way you read it is that high values mean high risk, and that there's more downside potential than upside potential at that given moment. And then low values would be the opposite, where there's low downside potential, but quite a bit of upside potential. And this is the short-term version of this model. So it cares what moves that play out over days to weeks, so shorter in the time frame that it's looking at. As you see, it does a really good job of capturing these low points, these local lows before big moves to the upside, and also these local tops before moves back down to the downside. And so you can see more recently is that in that first leg up that we had in October into November of last year, got really high, above 4. The max on this scale is 5. So very much chewing up the vast majority of its realistic upside potential in that moment. And then we consolidated. We basically chopped sideways for a while. The short-term UDPI cooled off a lot. And then we rallied a bit. We chewed up a good amount of upside potential, but not all the way up to the same level again. But now we're having to cool off again. And so when we look at this model and think about what does this mean for Link, there's a few things we can think about here. The first is that it's good news is that it's cooled off so much. Talked a lot about this model in the past where you prefer to see rallies out of low levels rather than out of high levels. A rally that starts out of a really high UDPI level might suggest that there's not a whole lot room left to run for the asset at that given point in time, whereas a rally off of really low levels can mean there's a lot more room if the broader market allows it. So seeing risk cool off like it has is a good sign. Now, I don't know if this is low enough to really be that staging ground for the next rally. It might be that this needs to cool off further, maybe back down to levels that we had back here, or even ideally further. Because then when we get there, if Link decides to run, it'll have more room to work with. So right now what I'm seeing, I think the possibility of some upside is certainly better than it was here, and obviously way better than it was all the way back here. But obviously it's never a guarantee. And this is really telling you the context, the conditions, the situation. It's not telling you that this exact moment has to be the point where it starts ripping to the upside. It's more saying that if it does, this is what we might be able to expect. That it has a lot more room to run now than if we had tried to run again up here, which in this case we didn't. We weren't able to. Higher risk, had to cool off first. Would maybe like to see it cool off more to set that really strong footing for the next rally. So the next rally could start tomorrow, it could start today, or it could start a while from now. But the lower this goes, the better it would be when that comes, is generally the way that you can think about this. So not financial advice, but that's just what I'm seeing when I'm looking at this model. So another model we can look at that gives a better idea of the trend and maybe if we are starting that next uptrend. So the UDPI is more looking at the conditions and what happens when we start that rally. This is now looking more about, can we identify that rally as it's about to start? So this is our trend confidence indicator, or TCI, and it's really designed to give us an early warning, as early as possible warning of a potential trend reversal, or at least weakening of given trends. So the way that you can read this model is that if the TCI is trending along with price, then that's a good sign in the case of an uptrend that that rally can continue. But then if you see the TCI start trending down, that suggests that that rally is either over or is going to be weakening, and that any continued upside is probably going to be relatively limited relative to what you just saw in the past with the rally. So for example, in this rally here, trending up, everything was good, but then as soon as you saw this starting to form, that was concerning, and indeed back down we went. But then you'll notice that the TCI started to trend up again back here, which is a good sign, suggesting that strength was coming back into the Link market. And indeed, that then catalyzed us to have this big uptrend on the TCI that corresponded with this big move up in price. But then going through here, and I was talking about this very vocally at the time, TCI was falling off a cliff, suggesting that this trend here was either over or going to be very weak, would have to wait. But then we saw this reversal again on the TCI, started moving up, and then price followed. So what I'm going to be looking for next with Link, of when we think that next rally might actually be relatively imminent, would be, when does the TCI actually start trending back up again? We have this local downtrend that's formed here, which is a suggestion of weakening, and indeed that's what we have seen. What I'd like to look for is, when does the TCI start moving up again in a notable or more aggressive way? And that might be a suggestion that that next leg is ready to kick off. So we're not there yet, but it's something I'll be watching closely. Okay, so that's kind of shorter term considerations with the specific rallies that we've seen most recently and some things to think about with those. But in a lot of ways, maybe what we care more about is the longer term perspective here with Link. That if we really are in the early to mid stages of a bull market right now, then really what we care about is just riding the wave to whatever the cycle top would actually end up being in that bull market. So this is our long-term upside potential indicator. So it cares about moves that play out over months to multiple months, much more macro in its time horizon. And you see it does a really good job of capturing these notable high points, these notable topping points, or at least close to them, and then also catching these notable bottoming points in a more macro sense in the Link market. And with this rally, we also, in this one going from October into November, we got to quite high long-term UDPI levels, which is again a reason why I said that might be a concern. We came all the way back down to negative 1.7, so quite low. And that was actually the exact moment, the catalyst, where the conditions were now better for a move up. And that's indeed what Link decided to do. It rallied. We're now sitting a bit above zero. So when I'm looking at the long-term UDPI, to think about a longer-term run that can really have a lot of legs in it, I'd ideally like to see this start coming back down again. It is, if we just zoom in, starting to slow off here and level off. So we see this start to come back down, and especially get back down to the negatives. That might be more conducive of that point where we might be able to really rally more aggressively out of that level. And we just look at the behavior now versus something like back here. There's some similarities we can see even just with this rally that we had from April of 2019 going into July of 2019, where we had this big move up. We got up to pretty high UDPI levels, similar to what we did here. Then we kind of came down and chopped around, where we came down to the negatives. We kind of came up, down, up. It was overall an uptrend, but it wasn't anything especially explosive. And then eventually, after this accumulation phase had kind of taken its course, then we went and put in the next big legs up in the bull market. And something like that would not be shocking or by any means impossible for Link to repeat again, where we might do a similar thing where this kind of acts as this maybe slightly upward sloping accumulation zone where we kind of come up, come down, maybe leg up, down, so on and so forth. Long-term UDPI just kind of oscillating around like it did back here. And then at one point, when you get down to this level, it'll act as that base for that next rally. And because you're coming out of such a low UDPI level, you'd have a lot of room to move. So certainly no guarantee that that would have to play out, but it's a hypothesis that I think will be useful to keep in mind. And it's definitely something to think about with Link and how it's acting right now. That we had that first expansion, maybe what it's doing is really starting to go into a bit of accumulation zone. Basically, everyone who doesn't want to hold Link is going to sell. Everyone who wants to hold it longer term is going to buy. That at some point, the supply dynamics are going to get such that there's not enough selling to offset that demand, and that'll send it upwards. So time will tell if that's what ends up playing out, but it would not surprise me if something like that were to happen for Link. So obviously not financial advice. You should make your own views of what you think is going to happen. But that's one thing I think might be useful to keep in mind and help to contextualize the price action we're seeing right now, where a lot of people are calling it really disappointing, but really what it might be is this kind of reaccumulation zone before something more exciting. And generally speaking, in bull markets, accumulation zones are the most exciting time because that's when you can buy the asset at a basically discount relative to what it might be able to do in the future. Okay, so one other long-term model that I want to talk about here is the momentum bias indicator, or MBI. So this, as the name suggests, really cares about momentum, and really, is it dominating to the upside? Is it biased to the upside, or is the momentum biased to the downside? So this is a Z-score. So basically 0 is the average amount of momentum that the asset has seen in its lifetime. And then these are standard deviation units above and below. So Link obviously has overall had positive momentum bias, given how much its price has appreciated in general over time. So that basically means 0 is an overall positive, and then units above and below are just degrees relative to that. And there are different phases that you can really identify with the MBI. And this is what I like to use it for the most in a lot of ways. Being able to identify, are we in a bull market, bear market, or somewhere in between? So one of the things you'll notice on the MBI is that it tends to behave in very distinct ways at those different phases. So in a bear market, it's spending a lot more time in the red than in the green. Then as you transition out of the bear market into the bull market, you'll sort of oscillate around zero. And because zero is overall positive, that's a good thing. That means you're kind of building a base, an accumulation, and then you usually will have some expansion. Then you might go back into an accumulation and then another expansion in the bull market. And then bear markets are the exact opposite. A lot of red, just brief pokes up into the green, as we're talking about back here. And then again, accumulation, and then going into bull market behavior. And so that's what I'm seeing really clearly in the MBI right now for Link. That we went out of this bear market, which was basically through this whole point, where this was very clearly bear market behavior. Then we started oscillating around zero, this entire range that we got stuck in for so long. But now with this expansion, we've now gone back up to these levels that we really haven't seen since bull markets, which might suggest this is the first expansion in a broader bull market. And we might now be re-entering into this kind of accumulation zone. Maybe we have to go back down and dip back below zero, kind of come up, come down, come up, come down. But ultimately that would just be in service of a broader bull market story, which might eventually build into that ultimate top. So far so good, basically, when I look at this. This is not suggesting me that we're about to go into a bear market or anything like that. This really looks like we had that first expansion, and now we're starting to get our feet back underneath us. So the final thing I wanted to talk about then, given those ideas that there is some room for short-term upside if we see the conditions align more. The short-term UDPI is already looking good. We just want to see the TCI confirmed to be more confident. But longer term, there is definitely room to run. It's just that we might take a bit of time to get there. And that's where I think it's really important to keep all of this in mind with something like Link. Something like Link is a very hated asset in a lot of ways. On X and elsewhere, a lot of reply guys show up to basically say it's never going to do anything. Its price action is really weak compared to other assets. Why would you ever buy it? But there's some things that we need to think about here. The first thing is that no asset is ever going to be the best performing asset all the time. That's just a fact. That's just the way it is. So in this phase up here where Link was outperforming the rest of the market, it was leading the way. Suddenly everyone was talking positively about Link. Everyone loved it. But then as soon as this started happening, then suddenly everyone hated it again because they saw other assets moving up higher, and then Link was kind of stuck in this accumulation zone. And so if you think that Link is useless and you don't want to touch it, that's fine. But then don't complain when it does go and rally and you missed out. That was your choice. Likewise, if you only buy Link, if you don't buy anything else and all you invest in is Link, don't complain if it has points where it's underperforming the rest of the market. That will always happen with any asset. And then one way you can play both sides of that is don't just only invest in Link. Invest in Link, invest in some others, and then you can basically catch upside of those other ones maybe while Link isn't doing so much. And then when Link is doing a lot, you catch that upside when maybe other assets aren't doing so much. But then in that case, don't complain that you didn't only buy Link or some other asset because you made the choice to diversify. So obviously none of this is financial advice. You should make your own opinion how to navigate the market. But it is something that I think is just kind of funny that people make these deliberate choices to either go all in or totally avoid an asset. But then get really upset when the market kind of goes against that choice. It was a choice that you made, and you have to realize the trade-off that you're making. That if you go all in on an asset, you'll get all of its upside, but you also get all of its downside. If you diversify, you'll get some of it. If you avoid it completely, you'll just benefit nothing from it at all. And those are just choices that you have to own. So what choice you make is totally up to you. I'm not going to tell you what you should do. But I do just think it's really funny, especially with Link, that it tends to be a very emotion eliciting asset in a lot of people. But I think it really boils down to those ideas where people make choices, but then they aren't really willing to own those choices, and they just go and complain on the internet. And so it's kind of funny. But in a lot of ways, sometimes when the sentiment is worse on an asset, when it's the most hated, that can actually be one of the best times to be accumulating. That actually happened back here. Link was really hated through this entire range. People got so bored of it, said it was never going to do anything else ever again. But then our models were flipping bullish on it and suggesting that it was actually a fantastic accumulation zone. And sure enough, off to the races we went, and we're up, off the lows down here. We're currently trading over 300% to the upside. So not anything to complain about by any means. And so that's where I think having data, having models is just such a better way, in my personal opinion, to think about markets than emotion. Because emotion will always get you. You'll always feel like you're missing out. You'll always feel like you didn't make the best decision. And then you'll just get angry at the decision or angry at the asset for not moving. And that can lead you to capitulate at the very worst time. To sell Link when it's right around here and miss out of it here, and then buy back in when it's up here, just to have other assets maybe go ahead and perform better. Emotions, generally speaking, are not going to be very helpful in markets. So that's my own personal view. You can have your own personal view. You should have your own personal view. Nothing of what I'm saying here is advice. But those are some things to think about more from the sentiment side. And when you're thinking about the trade-offs of how to navigate markets, and then just to realize those trade-offs and understand them so that if something goes against you, it's not just something that you're confused by or feel angry about, but you just say, okay, this is what I signed up for. I knew what I was getting into, and I'm going to ride it based on that. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us over on X. A lot of updates about our models and more over there. You can go to our website, claritydigital.io, to see live data from our models and more.